Will be. Hello, Warriors. I'm here with Andy Constant. Andy, welcome back to TradeGate Hub, buddy.
Hey, thanks, Dale. Appreciate it. Looking forward to it.
Andy, I was cruising through my living room and I had CNBC on, and I saw your face. Do you know what I did?
You turned it off.
No, I turned the volume on.
Okay, good.
All right. So congratulations on broadening your visibility on CNBC, and see you're out there a lot. I feel that we're fortunate to have you, and that I found you before you became too famous.
Thank you, Dale. I appreciate it.
All right. So what you were covering was they were going to come out with what the package was going to be for refunding the Treasury. And your statement was you didn't think the bonds were going to like it, especially if it was tilted towards the long end, and that stocks wouldn't like it either. That was they were both correct. The bonds sold off, S&P sold off, but how do you feel about the bonds now? There's been a little minor shift. I have the TLT up here, second decent week in a row. And the interesting thing to me, and I'd like your comment on it, is that although the TLT did not take out its October lows, where am I? Okay, the 10-year.
The 10-year did, right?
Did.
Yeah.
Okay, so I found that a little constructive myself on the long end, that the 10-year did it. Looks like the 10-year wants to come off too, although it's a light switch tomorrow with NFP. What's your stance on the bonds here and now, Andy?
Yeah, so I mean, I think of bonds in three ways. How's inflation going to play out? How's growth going to play out? And how's risk premium, which is supply and demand and vol and a bunch of other things that sort of drive, the sort of fair value of bonds. And I think clearly the last few days have been one of expectations of a weakening economy, starting with the JOLTS data.
Right.
That certainly was most of what drove yields down in the last few days more rapidly.
Yeah.
That changed the narrative a little bit from August, which, I've been sort of higher for longer for a long, long time, and manifesting that by being short 2-year notes. And we got to a point where 2-year notes are really priced in sort of what the Fed is saying is going to happen in their SEP.
Yeah.
And so I think we
fully discounted then.
Yeah, I mean, twos at least.
Yeah.
And so with twos sort of stuck, call it 5.25. They're a little lower today, but whatever. With those stuck, the 10-year is going to respond to supply and demand, which I think is very bearish for 10-year bond prices, and changes in inflation and growth. Today we got an inflation number which was right in line. The inflation numbers look like they're starting to reaccelerate. That bonds shouldn't like, but if we do start weakening, the economy starts significantly weakening, that'll be some support for bonds. So my position is short bonds, short 10s and 30s through, I think I have about 1.5% of AUM in each long puts.
Okay.
And, I expect those to pay me, but, if they don't, it's because the economy weakened, not because inflation fell and not because supply and demand dynamics changed. Those are both quite bearish, but at any point in time, a recession could come. Now, that said, that can't be good for stocks, and so I happen to be short stocks as well. I covered both bonds and stocks. I covered some of during the summer.
All right, so I wanted to talk to you about that. You notice, and I'm sure you do, that's really all one market. That based upon yields and what the dollar's doing, dollars weak, yields coming down. Bonds rally, stocks rally, risk on. And when the dollar's strong, it's a wrecking ball. Not today, but in general. Do you ever think we're going to come to a time, and you're just talking about economic numbers weakening, where the bonds could work like they did pre-22, where the bonds could rally and stocks suffer simultaneously. Because if that happens, the hook of getting lower yields would surprise people who would think that it's just jet fuel for the market, instead of people maybe questioning PEs and valuations with a weakening economy,
Yeah,
earnings.
yeah. I mean, that's what we've been experiencing lately, which is any rally in bonds lowers the discount rate for stocks and
Yeah,
and enhances the multiple because people
right.
are ignoring the growth signal in bonds. If
Okay.
that growth, I believe that in a recession, the markets will act the way they normally do in a recession, and that is, led by the front end of the curve, bonds will rally, but across the whole curve, bonds will rally and equities will sell off. And I just don't think that's happening in the near term.
No, it isn't. I mean, we're
What I mean to say is I don't think the recession is happening in the near term.
okay.
The,
So that this will be bond yields dropping, as TLT continues to advance, will drive the market higher for now until it's more obvious that we're heading into recession. So,
I'd say
or is this a failing rally we're getting in S&Ps? I was surprised by the recovery this week. I thought
yeah.
maybe 45, but it could still be a failing rally up here, don't you think, Andy?
Yeah, I mean, I'm bearish on both things, so I have to think it's a failing rally in both things because I don't
Okay.
think we're at the point where a recession is likely. I think recessions and job and unemployment rate increases, I'll fix that, jobs falling, um, unemployment rising, come in a cycle like we're in, which isn't a credit explosion, but a credit crisis, but an economic strength failing crisis. The first thing that has to happen is that bond yields have to rise and stock prices have to fall. And then you start seeing the decline in demand from the wealth effect as people realize that their homes, their stock market portfolio, their bond market portfolio are no longer cash registers, and reduce consumption. When they do that, then you start seeing the hit to earnings, and then you start seeing the firings that result in a recession. And so I think we're a long way off from that. At least I don't even expect it in next quarter's earnings to see any sort of real sell-off in earnings. But to get a recession, you need right now, today, 2024 earnings are expected to grow by 12%.
Okay.
You
All
need
right.
2024 earnings to be expected to fall by 12% before you get anything like a buyable moment for bonds.
Okay. But before they get there, the market's not going to wait for
Nope.
those numbers to get there. So you're short stocks and bonds currently. I wanted to ask you if you think that the bond market could do better even in this period. If we say get a sell off to 4,200, could bonds still go higher? You don't think we're going to get that type of growth
that
scare now?
I don't think so. I don't think we go to 4,200 on equities unless bonds sell off. I think
Okay.
it's the opposite, that
Okay.
4,200 is driven by a bond sell off where, an expectation that the Fed has more to do and inflation isn't tamed. And that's what drives us down, not the other way, where equities suddenly magically fall to 4,200 for whatever reason, which results in a bond rally. I think it goes the other direction.
I was looking at WTI actually played the short side for a day trade, but its action is pretty good here. I think this makes the people looking for lower yields maybe
Worry.
take a second look at what energy's doing.
Yeah,
It's the strongest sector out there as far as ETFs
yeah. I
too.
looked
One
at
of
the
the strongest.
CPI. I looked at the CPI expectations, not core, but with food and energy in it, and those numbers for next month's release look, eye-poppingly high relative to what we have seen. And so that's going to affect the inflation expectation. I have a long YOLO call left from a while ago, 95, 105 for December oil call spread.
Yeah.
If that thing plays out, it's worthless now, but if that thing plays out, obviously, bonds are not going to like it.
Okay. All right. So, we've covered a couple of asset classes. I know that you also trade gold. And, we've had a very nice rally
Yep.
here, kind of like with bonds. So let me guess that there's not going to be any differentiation here either, that if yields go higher and the market falls, gold's going to fall again too.
Yeah, it's just another asset at some level, but I would say that I work now with Jimmy Jude has joined Damp Spring, and
Yeah.
he was fairly enthusiastic about the technicals right near the bottom of gold,
Right.
and we caught that. I didn't make a positioning change, but we sort of pointed that out, saying that the technicals are pretty solid for gold. But I think it's getting stretched here. So
Yeah.
particularly if yields start rising again, you're going to see gold struggle. But I just think it's in better place than most other assets. And so, shorting it, gun to my head, what I would do, I would prefer to short bonds than short gold. But if I only had one trade to do, I'd short gold.
Okay. All right. So I actually am short silver. And I'm thinking that there's one more trip down in gold, maybe 1820, maybe 1800. And in silver, which is acting kind of stubborn, hit a little reversal day. Down here, I back up the truck at 2050 and sub 1800 gold. One of the reasons is, do you trade miners at all? I don't think that's your bailiwick. But I was taught they lead and they shouldn't be lagging. And you see that huge rally that we had in silver, and then you look at a stock like, well-traded stock. So here's AG, silver's up here, and the miners are not even really responding. They're lagging. So they're telling me I could be patient to buy the metals. Now, I know you were stalking a possible short in euro. I went with cable. I came out of the trade earlier in the week when it negated this head and shoulders formation, broke underneath it. If you're playing the formation, you cover if it's negated, false breakdown. Do you think the dollar, that was it for the dollar bound pullback? Because look at where it held, 103.
Yeah.
That's a pretty shallow pullback.
Yeah, so my view on the dollar is that it's probably in the middle of the pack in terms of the currencies. I think Asia currencies from Aussie to yen to renminbi are all likely to weaken further. And Europe and Britain, if I, gun to my head, I think the trade of 2024 is probably to be short pound, but I do a lot of work with institutional positioning, and institutional positioning has been, the last time they were as underweight long the pound and pound assets was right during the pre-Brexit experience.
Okay,
and
wow, that's a while ago.
Yeah, so they're very, very underweight, and they got underweight as soon as the LDI crisis happened October. And I just don't see, I don't like shorting, even though the fundamentals line up and the technicals may line up on being short pound. I don't like shorting when the entire world is underweight the currency that I want to short. And so I'm looking at that.
Interesting.
But I think there's a period of time in which, people start warming to the idea that the pound isn't going to crater, which, for a year now, people are expecting. And at that point, they position at least neutrally. And I think that's when you can put a short on if the fundamentals continue to be as weak as I think they are.
I know your preferred short was you were looking at the euro. So what's different between euro and cable?
Well, actually, I was looking at pound short against euro.
Oh,
So
okay.
long euro,
So
short
that would
pound.
be, okay, so it'd be long euro pound right here.
Yeah.
Okay,
And I've been looking at 85. It wicked there once
yeah,
and I missed it.
yeah.
But that's sort of the level that I'm interested in on that.
We
Um,
diverge very nicely here too, Andy. Look at the difference in the RSI reading. And
yeah.
as you know, they clean out the stops under this low and turn. It's pretty classic.
Yeah, I would look at that wick. I just
Yeah.
missed.
Okay. Uh, my guard was down. I was looking for a yen top to happen right around 148. I want to ask you, um, if the yen is peaking up here, and I don't know, maybe they'll make another stab towards 48, it's trying to hold here. But if it's peaking here, does that change the dynamics of the market with, say, the carry trade?
Yeah, so I don't think it's peaked. I think we're blowing through 150 eventually.
Okay.
The fundamentals are just still too weak. And there is no particular economic reason why they would want the yen to strengthen. They don't like it to weaken aggressively. And so, if we were to challenge 150 or something lower, higher on the yen dollar, but I think they would probably intervene. And that's the point I'd want to get short.
Okay.
When they
So,
intervene, then you get the $3 spike.
yeah.
That's when I'd want to short it. But I'm pretty bearish on the yen. Now, if I'm wrong and the yen starts rallying here, that speaks to once again the
There's your weekly.
world going into a recession.
Right.
And to me, that's where you start seeing equities really challenged in the United States.
Okay. So, if your 150 target is, it manifests, I do believe you'll see higher yields. They're very, do you watch a correlation between the two?
Yeah,
Of
it's
course.
obvious they're obviously strongly related.
Okay.
And we could
Uh,
see that if, we so far the yield curve control relaxation has had a modest impact on JGBs, certainly relative to some of the fear that was out there. But, to the extent that US Treasuries and JGBs drift, then you could start to see, that all playing out.
do you think our banking crisis is over, Andy?
So I didn't think we had a banking crisis. I think
Okay.
four banks
Sanguine.
four banks went under, or four, I guess, and those banks did stupid things. And I'm sure there are more banks that are going to do stupid things, and those banks are probably are being focused on by regulators aggressively to be resolved. I think we have to see bonds once again. It's a bond story. I don't see healthy regional banks with a 5% 30-year.
Yeah, I mean, the direct,
That's gonna create a problem.
right, that's what I mean. So I look at the regional bank ETF, and that was a pretty weak rally compared to what the rest of the market did in June, July, May, June, July.
Yeah, with the
Uh,
strength in the bond market, you'd expect regionals to be bouncing here, and they just aren't.
no, yeah. Are you, there are still massive withdrawals coming out of banks. You don't think there's any impact, or we don't have to worry about them, doing something draconian like limiting the amount you can withdraw from a bank? There are a lot of guys out there talking about debanking.
Yeah.
Is that hype?
Yeah, I think that's hype. Deposits are not falling anywhere near as fast. In fact, I think they're rising lately, anywhere
Okay.
near as fast as they had been falling during the banking crisis.
Phew.
Um,
I was
but
going to go empty
but
my
that
checking account, so I
but
don't
that
have to
said, I
worry.
think banks, across the globe are going to be impacted by depositors demanding higher rates.
How
Um,
about governments like the Italians putting on a windfall profit tax on a weak banking structure
yeah,
already?
yeah. I I'm not quite sure why they did that. That was an interesting play. Sounds political to me that you target the
Okay.
banks. And, people like Elizabeth Warren would certainly like to see
Oh, yeah.
IOBR reduced. Why is the Treasury paying, 5.3% to banks on $3 trillion of reserves? Anything can happen, but I think that becomes politics. I think the Fed and the banking system understands why they have to pay interest on this ample reserve regime.
Okay. And what about the new BRIC currency, Andy? You have a view? Some are saying a lot of bark, no bite.
I
Some are
don't.
saying it's going to change things.
I don't. It's a distraction for me, I think.
Okay.
For the moment, we're talking
Yeah.
about a currencies basket that is used for maybe 5% of total trade.
Even if Saudi has joined the group, you don't see that affecting the dollar as a petrocurrency.
I really don't. One day
Okay.
maybe, but not today.
Okay. All right. So what else is top of mind that you'd like to wrap it with here today?
Huh.
I know we covered a lot of ground.
Yeah, I mean, in terms of particular markets, I think the interesting thing is going to be the SEP and the FOMC meeting in September. We had Bostic, who is the dovest of the doves, maybe
Right.
only rivaling Goolsby, who was talking about, he has no interest in cutting rates anytime soon. In fact, he thinks it'll take a long time. And that's going to be manifested in the dot plot. Currently the dot plot has a 5.6% terminal rate, which is either 0 hikes or 1 hike. And, I think that's about right for 2023. And then in 2024, it has 100 basis points of cuts. And I'm interested to see whether the SEP will reduce that number of cuts to say 80 basis points or 75 basis points, because that's going to have a big impact on 2-year notes. If 2-year notes, currently 2-year notes are priced in about 120 basis points of cuts in 2024. And if the Fed starts committing to significantly lower numbers of cuts, twos could reach that point where they become quite interesting from a steepener standpoint to own twos against anything else. Now, a lot of people are long a lot of twos expecting weak economy. So I think you have a washout first, but there's a point coming soon, maybe it's the end of the month of September, where twos reach a buyable level from a leverage standpoint. From a cash standpoint, they're already fine, but from a leverage standpoint, they become interesting. So that's what I'm paying attention to in the next 3 weeks.
Okay. And I just pulled this from your stream. And so your model's been doing very well. I'm sure it's well, I'm not sure. Is it a model or fully discretionary? What is giving you these turning points? Is it sentiment driven?
It's 100%. It's 100% the levels of risk premiums and the pressures that risk premiums will face, either ones in which assets will do well or ones in which assets will do poorly. And we've gotten very, very lucky on, which is partly discretionary. My interpretation is discretionary. We've gotten very, very lucky. Right now, for instance, on the right side, after I covered, we've already bounced halfway back to the triple red bars as bonds and stocks. So I'm looking to, if we get much higher, I'm looking to reestablish that trade. And that's what my indicators would say.
Maybe next week when your fraternity brothers get back from the Hamptons.
Maybe. I would think they'd come in roaring to sell, but maybe I'm wrong.
Okay, well, Andy, congratulations on your new venture with Jimmy, and I hope it grows like a mushroom.
Thank you very much, Dale. Always a pleasure to talk to you.
Yeah, thanks for edifying us again today, Andy. Have a great holiday weekend, my trading warrior brother, Andy Constant, everybody.
Thanks.
Follow him at Damped Springs. Adios. Thanks again, buddy.